The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Darrell Martin.
All righty, folks. Welcome back here to the Diagnostic Trading Hour. I'm your host, Darrell Martin, right here on TFNN.com. And let's go ahead and take a look at a few different things today. And just getting a few things sharing on over there for you. And I wanted to talk a little bit more about Nadex spreads and how you can, put the positions together when you're doing your trading. Okay, there's a lot of cool things that you can do when you're trading over on the spreads, and there's a lot of ways to use them. And we had a great little webinar last night where we were covering Nadex spreads and just a lot of the misconceptions on the spreads that a lot of traders have that make them think, oh, they're not as good, or I don't like that instrument, or a lot of people, what I found is actually they completely confuse the spreads with the binaries. And there's at least a lot of false expectations. And it makes them actually fear the spreads, which sounds really funny to, fear the spreads. But they fear because they look at the risk and they have this all or nothing mindset because they're used to trading binaries. And I mean, I'm working with some experienced traders on these that are really wanting to get them down and, really master them. And I mean, they've done actually pretty well on the binaries, and they do okay. A couple of them do really well on futures and forex, and they're trying just to understand the spreads. And it's sort of funny because when these light bulbs click, I mean, they're like all over the place. One guy last night really arguing all about the spreads. It's like, no, binaries are better in every way. Da 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 da. Well, by the end of it, he's like, okay, this is freaking amazing. And so I want to just, go over some of those tips, some of those tricks, some of those things I went over last night with you. And to sort of, bring into, why I like them so much. Like, why do you like these, spreads? And, to tell you about, my background on them, I traded spreads for over 9 months before I touched my first binary trade on Nadex. And so the first thing I'd want to do is say, hey, if you think Nadex is just about binaries, okay, you're completely missing the boat here. My favorite contracts to trade on Nadex are the spreads. I didn't even touch the binaries. Before there was ever a binary scanner, there was a spread scanner, okay? And, there's a lot of, little things that I'm working on to try to, make it even easier and easier and easier to trade these spreads. But I just want to, help you grasp a few things. So what I'm going to do is I'm going to pull up, the S&P. The S&P is a very commonly traded instrument, okay? NASDAQ is, another, commonly traded instrument. And so we may pull up both of those and, take a look at them. Okay. And what I want you to see on this is, and this is where people get tricked up. They see this max risk, max reward going on. Okay. Max risk, max reward. And they think that's like an all or nothing. They think I'm either risking, $332 to make $68, or whatever. It's not like a binary, okay? It's not like a binary. So a binary is a very all or nothing contract, right? Whereas a spread is not an all or nothing contract. So the spread is a lot different than an all or nothing contract. And so I'm just trying to zoom in so you can really see what's going on. There's a lot of information on this screen that can make it a little bit intimidating. But what I want you to see is, I want you to, for one thing, we got a strike, okay? This is the actual width. This is the contract, okay? And this is the floor and ceiling strikes. So that means that, on this contract, basically, if you're buying it, you won't lose any money below the lower price there, 21.05. You won't make any money above the higher one, 21.15. If you're selling it, you won't make any, you won't lose any money above 21.15 and any additional money. And if it goes below 21.05, you won't make any additional money. You can still max out the profit in either direction. So we got floor and we got ceiling. Okay, the difference between the two is the spread. Makes sense, right? So 21.05 minus 21.15, that's 10. It's a 10-point wide spread on the trade. So pretty simple to understand how that works. So 10-point wide spread. Now, all the spreads, have a value of $1 a tick. And unlike the underlying, like on the S&P that ticks in quarters, all the spreads tick in an increment of one contract. One tick, $1. So if I'm looking at, say, the US 500, well, all I got to do is look at the spread and see how it says 2105.0. That means it ticks in 0.1. So 0.1, 0.2, 0.3, 0.4. Okay? So 0.1. Very, very simple. Okay? Now, what if I look at a different market? Let's go over to the Dow. Let me open up the Dow for you, okay? We'll pull this one up. Okay, on the Dow takes in whole numbers. See how the quote is on the floor and ceiling there? So it's 18,000 by 18,100. It's a 100-tick wide spread. It's still going to tick in a 1. So the last digit, it's always going to be that last digit, no matter where the decimal is. Okay? That last digit is always going to move in a value of 1. Pretty simple. Okay? So everybody had to get that pretty well. It's pretty simple right there. All right? So the last digit is always 1. Now, what if I go over to something that has, multiple? Ticks a little bit different, 0.0001 or 0.001. Well, let's look at it right here, 0.001. Notice how it's 0.00 right there. So it doesn't matter where the decimal is. If you can get the simple thing down, it makes all of a sudden the tick size is so much easier. It doesn't matter where the decimal is. Okay, it's always the last digit that it's quoted in, like on the bid or the offer. Okay, right there. That is going to tell you what the spread itself, what it ticks in. Okay? So again, what the spread itself ticks in. And that tick value is always going to be $1. So on S&P, like this is one of the things when you start trading futures, you have to learn, okay, the S&P ticks in quarters. Every tick is worth $12.50. Every point is worth $50. On the NASDAQ, it ticks in quarters. Every tick is worth $5. So a 1-point move is worth $20. On oil, every tick, it ticks in 0.01. Every tick is worth $10. So a 1-point move is $1,000. It keeps going and going and going. Okay. What Nadex did is they made it really, really easy. The last digit that the spread is quoted in is the minimum move, and it always moves in 1, and that movement is always worth $1 a tick. Okay? So if you put those pieces together, then now you understand how the price moves, at least as far as when the bid and offer of the spread changes, it'll move in a 0.1 fashion. Okay? So, or a 1, or a 0.01, or if you're looking at FX, like if we go over and we look at, say, Aussie dollar, then, it moves in 0.0001, right? So if we open that up, we see 0.0001. Okay? So, but every tick is going to be worth $1. That makes it pretty easy for you as far as being able to understand how much do I make or lose if this contract moves? Okay? So if I bought the contract at, 77.80 and I sold it at 77.90, okay, that's a 10-tick move, which means I make $10. If I bought it at 77.80 and I sold it at 77.70, that's a 10-tick move against me. I lost $10. Okay? If I bought it at 77.80 and it settled at 77.80, I broke even. If it settled at 77.81, I made $1. If it settled at 77.79, I lost $1. It's not all or nothing. It's $1 a tick, just like anything else that you think of. You know, if you do 100 shares of stock priced in pennies, right? If it moves 100 ticks, 100 pennies, 100 cents, you make $1. Okay? So it's $1 a tick in all scenarios. So why does this matter? Okay, well, one, I mean, you can put up a very little risk on the trade. Okay? If you wanted to do one mini lot, a mini lot on Aussie dollar or Euro dollar or pound dollar, okay, is basically going to require you, in most cases, somewhere around $200. It really depends upon the pair. I mean, Aussie's been getting, hit pretty hard. But if we just do a fun little margin calculation, if you go in and go, okay, well, 10,000 units, that's a mini lot, okay, times 0.7738. 7738. And then you get 50 to 1. So now you had to put $154 on the Aussie, okay, to be able to, if you're going to trade spot FX, okay, it'd take $154. Right here, $45, $94, because your risk is all you have to put up, your maximum risk, okay? It's the worst it can get. So there's one contract, $425 risk, okay? Max profit, $75. Not really any positive premium there. No reason really to trade that. There's a $198 one that's all the way at the top because the market is $77.83. It's above the ceiling. Okay, there's no value really left in it, so probably wouldn't want to trade it anyway. So all the contracts on here that you'd actually want to trade at this moment, they all have required less money for you to put up. So that means you're getting better leverage. Okay, they're moving at $1 a tick. You're getting better leverage. So what do I mean by better leverage? I mean your dollars are working harder for you. You'd have to put up $154 to control 100,000 units of Aussie dollar. Well, right over here, I could go in, and I mean, this is only like a tick away from where the market's quoting at right now. I'll show you what the leverage is when we come back, okay? So we'll talk about a few different topics on spreads. Hopefully a few of these will click some light bulbs for you. Stay right there. We'll be back right after this.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Darrell Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Alrighty, folks, going back here to the Diagnostic Trading Hour. And we're going over the spreads at the moment. Let me bring those back up on top of the chart here. We're going into basically how much less it takes, but how much higher the leverage is when you go in and you use Nadex spreads, basically meaning higher leverage but defined risk. Okay? So you can go in and use less money, smaller amount of money, and you can actually trade more size with that money. I'm not saying that you should go in and over leverage your account. Because again, this is not just high leverage with higher risk. It's high leverage with defined risk, and it allows you to trade a position. Because if you're only going to take, and here's where leverage, you have to get that point of leverage. Let's say you're going to have a 15-tick stop loss. Okay? And that's where you're getting out. If it goes against you by 15 ticks, you're out of the trade. All right? And maybe it blows through it and you get out at 30 ticks or something. Okay? It doesn't matter if you have 100 leverage or 50 to 1 leverage or 500 to 1 leverage or, whatever. What matters is what is your risk, okay, that you're willing to take on. So my risk is I'm willing to take on 15 to 30 bucks. So I don't care if it's a, $100 max risk. I want to get out if it goes $30 against me. Okay. It doesn't matter if I'm putting up $100 or 60 bucks or 150 bucks or 400 bucks or whatever. The bottom line is if it goes 30 bucks against me, I'm getting out of the trade. Okay. Now, leverage does matter if you don't have capped risk, because then you get an SNB Swiss franc moment, and all of a sudden you're down $2,000. That would never happen on a Nadex spread because they have capped risk. Okay. The most you could ever lose, worst case scenario, would be the maximum risk on the trade. But if I'm only going to, get out when it goes 30 ticks against me, then why not get the most leverage I can? Okay. So if we go in here, we go, well, to control, $70,800 with, $104, then, we're going to get a much higher leverage versus $154, right? So to show you how we did that calculation earlier, we went in, we had 10,000 times 0.7780. I said, okay, you can control $7,780. All right. So if I divide that by 50, I get my leverage. Okay, multiply it times 50, get back to the number. Now, what if I divide it by 102? Now I'm getting 76 to 1 leverage. Okay. What if I divide it by $14? Now I'm getting 555 to 1 leverage. So my leverage goes up massively. But again, I have capped risk. And if I'm going to get out, if it goes 15 or 20 or 36, whatever against me anyway, then that's just a better use of my money. It also allows me to trade a larger size with a smaller account, which, in one sense, people go, well, hey, you don't want to trade a larger size with a smaller account. Well, $15 is an acceptable risk on a trade. And my account is enough that $15 is an acceptable risk. I don't care how big your account size is. One guy may be doing 1 contract, another guy may be doing 100 contracts because he has a larger account. Okay? So, but that leverage allows the smaller guy to do the trade. Okay? And only take on $15 risk while the larger trader or gal, is going in and doing 100 contracts. They're risking, $1,500. Right? So, that leverage allows a smaller trader to not only put on positions, but also larger traders to put on positions and use their capital in a more efficient manner. Okay, so we have great leverage on many of the contracts. Some of the contracts, you get down here, leverage may not be as good at this point because you're all the way at the top or bottom of the spread. Okay, but there may not really be a good reason to do that trade. Now, so we got down ticks. All right. And we got down, leverage, maximum risk, maximum loss. Where does that come from? Well, if I buy it at 77.83 and it can only make money up to 78.40, then I make 57 ticks. Okay. Now, what if it goes up to 78.50 or 60 or 70? I still get my 57 ticks. All right. So that's the maximum risk. It doesn't mean it goes away. It doesn't have to expire inside the spread. Okay, it can go way above it, and you still get that maximum profit. Okay, if it goes down, if I buy it at 77.82 and it goes down to 77.40, well then I'd be losing $42. If it goes down to 77.10, I'd be down $42. Okay, so max risk, max reward, pretty simple. We also talked about profit and entry and exit. Obviously, profit won't be greater than max profit. Risk won't be greater than max risk. Stay right there. We'll be back in just a minute.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All righty, folks, welcome back here to the Diagnostic Trading Hour. What we're looking at right here is we're talking about the spreads. We talked about how you calculate profit and loss. It's different where you buy and sell in ticks, and everything ticks in a minimum increment of 1. We've talked about, a spread is the difference in the floor and the ceiling. That's the width of the spread, which is max risk, max reward combined will equal that difference. Okay? We talked about how max profit, if it goes above the ceiling, you still get it. If it goes below the floor, the most you lose is the max risk, but you still if the trade comes back before expiration, you can still be profitable on the trade. We talked about how it's not all or nothing like a binary. So if it expires 1 tick below where you bought it, then you lose $1. 1 tick above, you make $1. 10 ticks above, make $10, etc. Okay? So distributing it's variable payout like a normal instrument that you would trade. And now I want to go into 3 other pieces that are, I guess you could say this, so if you got everything down that we went right there, and if you can grab the concept that you're not necessarily taking on a massive risk to do a trade, okay? Like if I'm not putting up $105 to take on a $105 risk to go over here and sell the Aussie dollar, okay, on this contract. Yes, I am putting up $105 in risk, but if it moves 15 ticks against me, I get out. It doesn't matter if there's an hour left till expiration or 5 minutes left till expiration, okay? So I don't have all that complexities that I have to deal with binaries. I don't have, one thing I tell you is my heartbeat goes a lot slower. I can put 100 contracts on a spread and have less heartbeats per minute that I can have on a single contract on a binary, just because every 10th of a tick counts for total win-loss on a binary, whereas it's tick for tick on spreads. It's much more relaxing, okay? All right, so those are all the things that we've covered. The next thing I want to cover is this whole in the money, at the money, out of the money, deep in the money. What is that? All right, in the money just means that the market, the indicative here, is trading somewhere in between the spread itself. So 77.75 is between 77.40 and 78.40. Okay, so between 77.40 and 78.40, that 77.75 is in between that number. Let me go over here and so this one right here is, now what is at the money? At the money basically means it's close. It's within 10 ticks of the market. Okay? So what is that? What do I mean within 10 ticks? Well, that's that proximity number you see right there. So market's at 77.70, 6.8, so rounded to 77.7, right? So that'd be like 1.2. So it just rounds to 1. So it's basically 1 tick away from where the market is. The market's at around at 77.77, and this is a buy at 77.78. Then I'm buying it 1 tick higher. Positive 1 means higher, right? I'm buying it a tick higher than where the market's currently trading. Okay? It's an option. It sometimes doesn't have premium, but it's very important that you understand that. So I'm buying 2 ticks higher than the market. So if I bought this contract and the market didn't move at all, I could lose $2 on the trade. Okay? And it's as of expiration. Premium doesn't disappear just because you get in. Just like you don't make it just because you go on the other side of premium collection. You don't lose it just because you go in and, enter paying the premium collection. So if I held on to the trade till expiration, then it could cost me $1 to $2 here in premium. 1 to 2 ticks. Okay? So just as it, fluctuates in rounds often. It's really about the rounding going on there. The next thing I want you to notice, once you get down that proximity, pay attention to it. Because if it gets larger, the larger it gets, the further the market's going to have to move for you to be, profitable on the trade. If you're paying premium, if you have negative premium, okay? So negative premium basically means that if I'm buying higher than where the market really is, right? If I buy higher than where the market is, the market needs to move for me to make money. So like on here, I'm showing like at negative $1, okay? If I'm selling lower than where the market is, then, it'd be negative, like here, like negative $2, a couple ticks lower than this right here, all right? Now, what if I'm selling higher than where the market is? Okay, so if I went in and sold this contract, it's actually 49 ticks higher. So selling higher, usually a, good thing. Then, I can actually make some premium on this. So there's a lot of cool ways that you can start looking at premium and premium payment, premium collection. And, as you get this down, then you'll start to understand the spreads. Now, the biggest thing I want you to get today on spreads, okay? The biggest thing I want you to get today on spreads right here is where the money's at, okay? Like where you can really get in there and potentially make some profit on the trade. Well, where that is, that thing that you really want to be focusing on, okay, is the range. So let me take a screenshot over here, or we'll try to do this. Maybe I can just do a chart markup. But on the range of the spread, so there's that width. Remember we said the spread width like is 100 ticks? And a lot of people, like what they want to do is they go, man, this thing just doesn't seem to move. And so I want to help you understand why it's not seeming to move for you. Okay? So let me grab this so I can write all over it. Okay, so right here, if we go in and we're going to look at, like, this is the range. This is the 100 ticks, okay? The middle 40% of that range, okay, so like right here in the middle, about the middle 40% or so, this spread is going to move pretty much at the speed of the underlying market. Now, as you get closer to expiration, that number that gets wider and wider. But what I want you to understand is it'll move faster. It'll move more like at a 1-to-1, okay? Again, the market moves a tick. You'll see the spread move a tick, you know? So it'll move more like a 1-to-1 when it's in that middle 40%. And that's sort of that's your money zone if you're trying to trade directionally, okay? So if I go in here and let's just flatten that so I can highlight it. So if you're trying to trade directionally, right there, that's sort of your money zone. This is where it's going to move fastest, okay? So that middle 40%. So middle 40%. And this is where people get all tripped up. Because they don't understand that it is, I mean, it's an option. Okay, you're not trading the Aussie dollar, you're trading a option. You're basically trading a vertical. And so that vertical is going to, the way the delta works out, it's going to have a very high delta in the middle. So delta means the rate at which the option changes. And so if you buy in that middle 40%, like if I buy down here, then I'm going to see, you know, the spread move pretty much tick for tick really well with the Aussie dollar. And then as I approach the ceiling, now this is, you know, given that there's more time to expiration. I mean, 19 minutes, you'll probably see it move fast regardless. But as you can see right now, like it's trading on par with 10 minutes left till expiration. But as I get closer and closer to the floor ceiling, and if there's more time to expiration, like the more time there is, the slower it will move. Okay? So right there, it moves fastest, but I want to add in the one, let's see here. We'll add in a little note, okay? Closer to expiration, contract will move faster in step with the underlying. Okay, so notice this one has 19 minutes, and they're basically trading on this at the same. All right, let's go down here and look at these. We got a couple more down here, all right, that we can look at. 77.80. You know, we go and we look at, say, that middle. Let me get rid of that one. That middle 40% again. This ought to be a pretty good example. So right here, you know, just sort of guesstimating here, but right there we got about that middle 40%. Okay? And notice what's happening. Look at it, look at the price. Okay? We're in that middle 40%. And it's basically trading as if it was the ones above it. Okay? And it doesn't matter if there's an hour and 19 minutes versus 19 minutes to expiration because we're in that middle 40%. Okay? Now notice this one is a little bit further out. Right there. And notice how the proximity is larger. It's moving slower. Okay? So it's not quite moving at the same speed as the other contracts are. All right? So I just want you to understand, just starting to, you know, grasp that whole concept of how the contract moves, how the speed moves, and you'll learn over time, the more you trade these, the longer you trade these, that it really is about the distance from the floor and the ceiling. Okay, so the more ticks away it is, the faster it's going to move. The less ticks away it is from the contract, the slower it's going to move. Okay. Another thing that you'll learn while watching them is that as they get closer to expiration, they'll move faster. But where this trips people up is they go in and they buy like this $12 contract, and they get all pissed off because they only see, like, the market moves 4 ticks and they only see it move 2 ticks. Okay, so it's like, man, the market moved 40 ticks and my spread only moved 10 ticks or this or whatever. So it moved a whole lot and they didn't see as much profit until it got in that middle 40%. And so they feel like they're getting hosed. They don't understand that there's premium, which causes the delta to be lower and the gamma to be lower. So it has a lower delta, and until that gamma gets higher, that middle 40% is not going to move faster. So to make that simple, the easiest rule I can give you without getting all when we get mathematical, we can get really accurate. Without getting all mathematical and overly accurate, when you buy spreads or sell spreads in that middle 40% zone, you don't even have to carry about what the time is till expiration. So I am often looking for the latest expiration I can get in that middle 40% zone when I want to do a trade. And I ideally want the most when I want to do a trade mirroring the underlying market. And I ideally want the most profit potential in the contract I select. So looking at all these contracts, this contract right here would be my first choice. Okay? So my first choice on the contract that we're choosing, simply because, you know, I have 100 ticks of profit potential in the trade. I don't think the Austin's going to be moving 100 ticks in the next hour and 19 minutes. That's more than enough, okay? And could I choose the 88 tick one? Well, it has less profit potential, but I don't think it's moving 88 ticks either, so that doesn't really matter. But that's only $12 of risk. True, but I'm going to give up some ticks of movement before that thing starts moving faster. Like, it may have to move 10 or 15 ticks before I see the thing going in lockstep like all the other contracts are. Okay, because it's not in that 40% marker yet. So on 100 ticks, 40%, you got 30% on each side. So it literally has to move maybe about 18 ticks before I start seeing it tick 1 for 1. So if it moves 18 ticks, maybe I see it move 10 ticks. All right. Whereas if I buy this one and it moves 18 ticks, I see it move pretty much 18 ticks. So do I want to get 10 ticks out of the next 18 ticks, or I want to get 18 ticks out of the next 18 ticks of movement in the direction of my trade? If I want to get 18 ticks out of it, then this is going to be my trade of choice, okay? That one with more profit potential in the trade, okay, where the price is near the middle of it, and I'm not going to be freaked out because the thing says $100 risk or 180 or 200 or whatever, because my stop loss is 15 ticks below. If it goes 15 ticks against me, I'm going to get out of the trade. So I don't care if it says 40 or 90 or 100 or 60 or 196. If my stop is 15, my stop is 15. I'm going to get out if it goes 15 against me. If I'm going to be a disciplined trader, then I don't have to even worry about that. Okay? So we will talk about one of our next shows about how to hedge a spread with a spread, how to hedge, you know, futures and forex with the spread. But this right here will get you on track, at least understanding it's moving tick for tick with the market in this zone. If I start getting outside that 40%, unless we don't have a lot of time till expiration, it's not going to move near as fast. All right, stay right there. Come back, we'll talk about one of my other favorite topics, which is premium collection.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of of shorting and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they've just released the second running of their 5-year Market Safe Futures Economy CD. This is a CD that could really deliver, but you only have until June 11th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all of the upside at maturity. And should they lose, no worries. There's zero downside risk here, as you get back 100% of your deposited principal. Don't miss out. The June 11th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, going back to the Diagnostic Trading Hour. One thing I wanted to make sure you understood again was that premium. So we've been going through the entire show. We've been talking about how spreads work, and really not so much a spreads 101, but after you've taken spreads 101 and then you place trades and then you don't know what's going on and you make a lot of assumptions, then what? Questions, okay? And so we've been trying to knock those out back to back of ones that I get getting helping with people out. So we talked about, if you buy higher than the market, that's paying a $2 premium. Look right here, you buy higher, you're paying a $2 premium. If you buy 4 ticks higher than the market, you're paying a $4 premium. If you sell, okay, if you sell a tick below the market, you're paying a $1 premium, right? Makes sense. If I sell a tick below the market, I'm paying a $1 premium. That's pretty simple math, okay? And premium is really easy for in the money and also for going in and looking at the money trades. At the money just means the market, the indicative index there is 10 ticks of where the spread is priced. So at the money is always in the money, okay? So if at the money or in the money, really your proximity is your premium. Makes it sort of simple. And again, if you're selling below the market, you're paying premium. If you're selling above the market, a positive number, like right here is an example. or this is one tick above where the market is, then you're actually getting a tick of premium. Okay, I'm not saying this is a great trade, but you're getting a tick of premium on this because you're selling at 77.79, the market's at 77.78. Okay? So we're getting a tick of premium on this one. We're making premium. I mean, if the market stays flat and doesn't move at all till now in expiration, we make $1. Okay? On these, we're selling a tick below the market. So if the market doesn't move down a tick by expiration, we're going to lose $1. Now, I don't have to make that $1 right away because it doesn't go away just because I get in. Okay? But by expiration, it needs to move down a tick to settle. Okay? So now these are really small premiums that we're looking at. We're not looking at, big premiums and stuff like that like you might see over on some of the other markets. So other markets we may see a lot higher premium that we can check out. So let's check out one of those markets like the Nasdaq. Okay? So over here on Nasdaq, I can see trades where I can go in and I could buy this contract. Okay, 45.30 right there. I could make $57 in premium on it. All right, so I could buy the 44.90 to 45.30 and make a little over $50 in premium. I could sell this contract and make $56 in premium on the trade. Okay? So that is over 100 ticks in premium. And that's middle strike is 45.30. So if it stays basically first between 45, if it stays at 45.23, right now the market is at 45.28. So I'm buying 5 points below, okay? And it's $10 a point because it's $1 tick and it ticks in dimes. Buying 5 points below, if the market stays where it's at right now, then I'll end up having a profit of $50-something on the trade. This one right here, the market's at 44.29. I'm selling at, basically $60 premium in the market, so 6 points above where the market's trading at. Make about $60 on that trade. Combine that together, that's $100. So if the market moves up 10 points or down 10 points, a 20-point range, I have a premium collection trade. I talked about that a lot last week on the Diagnostic Trading Hour. So go back and watch those shows if you haven't. We did a trade on Friday morning that worked out, and we'll talk a little bit more about these trades later this week. Sarah, great show coming up for you right after this.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. You're watching Tiger TV.